It has officially begun. The most important signal in the last 40 years of precious metals trading just flashed across the screen, and the mainstream media is completely ignoring it. Yesterday, at exactly 8:30 a.m. New York time, the silver price touched the critical resistance level of $85. And then, something impossible happened. For decades, we have been conditioned to expect the bank smash. Every veteran stacker knows the feeling. It's a visceral memory. Every time silver touches a new high, whether it was $30 in 2021 or $50 in 2011, the bullion banks unleash a limit down attack. They dump billions of dollars in notional paper contracts in a matter of seconds. The goal is psychological warfare, to crush the sentiment, trigger the stop losses of the weak hands, and send the price collapsing back into the basement. Yesterday, they tried it again. We watched the level 2 data. We saw the red candles fire. We saw the algorithm trigger the sell orders. We saw the volume spike to 5,000 contracts in a single minute as the shorts tried to paint the tape and trigger a liquidation cascade. But the price refused to fall. Instead of crashing $2 or $3, silver stood its ground. It absorbed the selling pressure like a black hole. Every contract the banks dumped was instantly bought. The price didn't drop to $80. It stabilized at $84.80, consolidated for 20 minutes, and is now coiling for the next leg higher. This is a commercial signal failure. The machine that controls the price has broken. The Maginot line of the paper shorts has not just been breached, it has been overrun. The banks fired their biggest cannon, the liquidity flush, and the market didn't even blink. This proves that the Fed put is gone. It proves that the JP Morgan put is dead. The shorts are now trapped in a trade that is going against them with violent momentum. They are naked short in a market that has run out of physical metal. If they couldn't crash it at $85, they can't crash it at all. The suppression era is over. The price discovery era has begun. And for the shorts, this is not a correction. It is an extinction event. Part 2, the gamma trap, technical deep dive. To understand why the banks are terrified right now, we have to peel back the layers of the derivative market and look at the gamma wall. Most people think the price of silver is set by people buying and selling bars. It isn't. It is set by the options market. The wonder market makers, the big banks who facilitate trade, have sold millions of ounces worth of call options at the 85 strike price. They collected the premiums, betting the price would never stay above $85. They treated those premiums as free money. But because silver refused to fall yesterday, those options are now deep in the money. This forces the banks into a gamma trap. Here is the mechanics of the trap. The market maker must be delta neutral. If they sold you a call option, a bet that prices go up, they are effectively short the market. As the price rises, their short exposure grows. To neutralize this risk, they must buy the underlying asset. They must buy futures contracts. But here is the nightmare scenario. By buying futures to hedge, they drive the price higher. The higher the price goes, the more gamma they have to hedge. The more they hedge, the higher the price goes. It is a doom loop. Usually they smash the price to break this loop. They force a sell-off to get the price back below the strike level so the options expire worthless. But because the smash failed yesterday, the loop is accelerating. The shorts are now fueling the very rally they are trying to kill. We are seeing open interest explode to record highs, but the price isn't dropping. This is the smoking gun. It means new shorts are entering the market to defend the $85 wall, and they are being swallowed alive by the gamma buying from the hedging algorithms. The computer is confused. It is programmed to sell into strength, but the strength is relentless. The robot is fighting physics, and physics is winning. The failure to crash at $85 has turned the options market into a weapon against the banks. They are no longer driving the bus. They are being dragged behind it. Part 3, the Shanghai vacuum, the geopolitical floor. Why did the smash fail? Who stood in front of the steamroller and bought the dip with such ferocity? It wasn't retail investors. It wasn't Reddit. It was Shanghai. We have to look at the geopolitical chessboard. We have been tracking the arbitrage gap for weeks. Right now, the price of physical silver on the Shanghai Gold Exchange, SGE, is trading at a massive premium to the COMEX price in New York. We are talking about a spread that converts to roughly $90 or $92 per ounce. Think about what that means. If you can buy a paper contract in New York for $85 and sell physical metal in Shanghai for $92, you have a guaranteed risk-free profit of $7 an ounce. This is called arbitrage. When the New York banks tried to smash the price at $85, they effectively put silver on clearance sale for the Chinese industrial complex. They made the arbitrage trade even more profitable. This is the Shanghai put. It is the concrete floor under the market. Every time the West sells paper, the East buys physical. They are using the arbitrage to drain the Western vaults. We are hearing reports that the load-out queues at the COMEX are lengthening. Metal is moving from registered or available for delivery to eligible, private storage, or leaving the system entirely. The flow is one way, west to east. China knows the dollar is failing. They know the debt spiral is mathematical. So they are converting their trade surplus into hard assets. They are not speculating on a chart. They are securing strategic reserves for their solar panels, their EVs, and their military. The shorts in New York are fighting a ghost. They think they are fighting speculators who will panic when the price drops, but they are fighting a sovereign superpower that wants the metal, that needs the metal for national security. That is a fight the banks cannot win. Now, let's leave the charts and go to the factory floor. The reason silver refused to fall is because the industrial users have panicked. We need to talk about TOPCon solar technology. This is the new standard for solar panels. It is more efficient, but it uses 50% more silver than the old PERC technology. The solar industry is consuming silver faster than the mines can pull it out of the ground. Companies like LONGi Green Energy, Samsung, and Tesla operate on a just-in-time inventory model. They rely on the market to deliver metal exactly when they need it. They don't hold months of inventory because that ties up capital. But yesterday's volatility terrified them. They saw the banks try to crash the price and fail. This told them that the supply is tight. If the price can't go down, it must go up. So what did the procurement officers do? They shifted to just-in-case inventory. We are seeing market on close orders from industrial buyers sweeping the floor. They are buying physical metal at 85 not because they are traders, but because they are terrified of running out. This demand is price inelastic. The cost of silver is a tiny fraction of a solar panel or an electric car, maybe $20 per unit. If silver goes to $100, the cost of the car goes up by $5. It is negligible. They don't care if silver is $85 or $100. They care if the assembly line stops. If the price goes to $100, they will still buy. If the price goes to $150, they will still buy. This creates a floor that the paper shorts cannot break. You cannot spoof a shortage. You cannot print physical metal. The industrial panic has removed the elasticity from the market. The shorts are trying to bluff a player who is holding a royal flush. Part 5, the unobtainium phase, retail reality. So what happens next? Because $85 held, we are entering the unobtainium phase. The disconnect between the spot price and the real price is about to widen into a canyon. The banks might try to keep the screen price at $85 to save face, but try to buy a monster box of Silver Eagles tomorrow. You will see the sold out signs appear. You will see premiums explode. Dealers are terrified of replacement cost. Imagine you are a bullion dealer. You sell a coin today for $85. You make a small margin. But tomorrow, the price gaps to $90. You now have to spend $90 to replace the coin you just sold for $85. You lost money. So what do dealers do in this environment? They widen the bid-ask spread. They jack up the premiums to cover the volatility risk. They simply stop selling. They go bid only. This is the force majeure scenario for the retail investor. You have the cash in your hand. You want the metal, but you can't get it. The supply chain has snapped. If you're sitting there with cash, waiting for a pullback to $70 to buy, you are dead in the water. That train has left the station. The failure to crash at $85 suggests the next move is a gap up. We could wake up on Monday morning to find silver trading at $90 with no way to enter the market. The spot price is becoming a ghost number. It is a reference point that nobody can actually trade at. The real price is being discovered in the back alleys of the physical market, and it is much, much higher. Part 6, the verdict and the minor pivot. So here is the final verdict. It is over. The suppression is dead. The banks are trapped. We are witnessing the greatest wealth transfer in history. It is flowing from the paper assets to the hard assets, from the debt-based system to the resource-based system. Where does the smart money go now? It goes to the miners. If silver holds $85, the mining companies are printing money. Let's look at the math. A primary silver miner has a cost of roughly $20 an ounce. At $25 silver, they made $5 profit. At $85 silver, they make $65 profit. That is a 1,200% increase in free cash flow. But their stock prices are still asleep. They are trading at valuations from 3 years ago. Wall Street hasn't done the math yet. This is the miner pivot. This is the leverage play. We are moving capital into the unhedged miners, the ones who didn't sell their soul to the banks, the ones in safe jurisdictions like Canada and the US. And finally, the exit strategy. We are not holding forever. We are watching the gold to silver ratio. Right now, it is around 51. When it hits 31, we pay attention. When it hits 15:1, we swap. We trade the volatile silver for the stable gold. We lock in the wealth. The refusal to fall at $85 was the signal. The run is on. The vault is draining. Hold the line. Subscribe to the channel because we are tracking the gamma wall daily. You need to be here when the next leg up begins. Class dismissed.